The leverage effect is a financial phenomenon that describes how changes in a company's capital structure, particularly the use of debt, can impact its overall return on equity, ROE, and risk profile. This concept is crucial in corporate finance and investment analysis, as it highlights the trade-off between debt and equity financing and its implications for a company's financial performance. Leverage itself refers to the use of borrowed funds, debt, to finance a company's operations or investments. When a company takes on debt, it increases its leverage, which can amplify both gains and losses. The leverage effect becomes apparent when analyzing a company's ROE, which is a key indicator of its profitability and efficiency. To understand the leverage effect, it's essential to recognize that ROE is calculated by dividing a company's net income by its shareholders' equity. When a company employs debt financing, it effectively magnifies its equity base because debt adds to the company's assets without increasing the equity. This means that with the same level of net income, the ROE will appear higher when there is more debt in the capital structure because the equity base is relatively smaller. In favorable economic conditions, when a company earns a return on its investments that exceeds the cost of borrowing interest on debt, the leverage effect can work in its favor. The amplified equity base can lead to a higher ROE compared to a scenario where the company relies solely on equity financing. This is because the profits earned on the borrowed funds contribute to the overall returns, while the cost of debt remains fixed. However, the leverage effect also has a downside. In times of economic downturns or when a company's investments underperform, the impact of debt becomes more pronounced. Since debt comes with fixed interest payments, even a slight reduction in earnings can lead to a significant decrease in ROE. The company may find it challenging to meet its debt obligations, increasing financial risk. Additionally, high leverage can make a company more susceptible to fluctuations in interest rates. Rising interest rates can lead to higher interest expenses, reducing profitability and negatively impacting ROE. Investors and analysts closely monitor the leverage effect when evaluating a company's financial health and risk. A highly leveraged company may be considered riskier, as it has a higher chance of financial distress if it cannot cover its debt obligations. On the other hand, a company with low or no debt may be seen as more stable and less risky, although it might miss out on the potential benefits of leverage during favorable economic conditions. In conclusion, the leverage effect illustrates the impact of debt financing on a company's return on equity, ROE. While it can enhance ROE during prosperous times, it also increases financial risk, making the company more vulnerable to economic downturns and fluctuations in interest rates. Understanding the balance between debt and equity is essential for investors, creditors, and company management when making financial decisions.